Welcome, Pat. Happy Friday. We made it.
Rick, how you doing, buddy?
Friday already. I am in my palatial estates of my RV, and I'm down at Karshner Caverns. I'm going to tour the caverns at 3 o'clock today. Never been.
Yeah.
So I hear it's pretty cool. So
just don't bring, as I told you before, don't bring a Wuhan bat disease back with you.
Yes, no, we don't want to do that. And we don't have Jackie on this week. We had her on last week. Now, did you get the same email I got? She joined the Screen Actors Guild.
Yeah. Well, I think something happened. Yeah, she got movie offers. But I mean, it's kind of like our show is kind of like the America's Got Talent. You might not make it the next week.
Yeah, we're evaluating it day by day. But so we're going to go over a bunch of numbers today, and I want people to stay tuned because we've got some big stuff coming up here pretty soon. And well, speak of the movie star.
Oh, there she is.
Hi, Jackie. She's back. Yeah, you need to stay tuned, people, for news. We got some collaboration we're working on here, so it's going to be fun. She said, I did have my card at one time, didn't I tell you? Why does that not surprise me? That's pretty funny right there. So going to kind of get rocking and rolling here. Let's see. We had another comment down here from Derek that says, you must have some great Wi-Fi in that trailer. Actually, Derek, you know what I have? I have a dome on the cops called the Wine Guard. And whenever you're in an RV park and you look at available Wi-Fi networks, they all say Wine Guard because everybody's got the same thing. But I have a Verizon card. It's right up above here, and it's a little Wi-Fi unit. So it takes the cell signal and it boosts it, and I have Wi-Fi inside the trailer, and it's working out pretty good. I've had a couple spots where it has been no bueno, but for now I think it's doing the trick. So let's take a look at what's happening in the market right now. We have 6,500 homes on the market for a Friday, and that's certainly been higher than what we've seen. I think that's what, Pat, 400 higher than last week?
Yeah. Yep.
So no longer are we getting on here and saying 4,800, thank you, have a nice day. It's now what we've seen is we're seeing that sales activity is really starting to slow, and the Crawford Market Index is showing there's a lot of cities where the advantage for the seller is sliding pretty quick. Now, you're not going to feel it out there yet because remember, we're still above 100, with 100 being a balanced market. So if you're out there boots on the ground, you're not quite feeling it yet. We're seeing price changes, price reductions climbing at about a 1,200 unit clip over a 7-day average, which that used to be about 800. So it's not a huge number, but percentage wise, that's pretty big. If I go over, before I get to that, Pat, was any lending news this week?
Lending news, and I could bore the heck out of somebody.
Kind of stayed right there, right? So
I can pull out you want me to bore the group to death and pull out Fannie Mae guidelines, or is that what you're saying?
Yeah, that's a Friday killer.
Yeah, no kidding.
Well, the Fed's meeting on Tuesday, right? Is that when they're meeting again?
Yeah. They probably, obviously the big news. Obviously, you're gonna probably have the 50. There might be a 75 bip spike. You never know, but they're saying 50. Can you share did I share my screen?
Right,
yeah, basically today we saw some blow off today on the the 4.5 coupon was down 48 bips. The 10-year U.S. Treasury got to 293. It was at 294 here. It was up 7. We're getting these days. It's kind of crazy, Rick. This number right here, 48. We're seeing like these big candles right here. Here. These big candle marks right here. These are there's some big movements, and down 48 bips. Back a couple of years ago, I'd be like, oh my God, this almost seems like it's been the norm lately because the bonds have been opening up down. They were actually opened up down 60 basis points in the beginning. So
does that make it more expensive to lock your rate?
Oh yeah, basically on if it was down 50 bips, 50 basis points on a $300,000 loan, well, let's say a $400,000 loan, basically it basically makes your cost about half a point. So 400,000 is about $2,000 more in costs in one given day.
Jeez.
So basically, because a lot of the lenders, when the problem is when things are volatile, the lenders are real quick to price when it gets negative. But when it gets positive, if we saw this number right here be up 50 basis points or up 60 basis points, you're seeing the lenders not pass along that pricing as quick because they don't want to get burned. They don't want to give out a good price on a bond or a mortgage rate just in case all of a sudden it turns around and it goes negative. So they're going to give out, they're going to take away your gains real quick, and they're going to give out, the losses. They're going to just absorb. They're going to say, "Hey, sorry, we're repricing for the worst." I mean, typically now it's not unusual to see 2, 3, 4 rate changes in a given day, and so it makes it very tough for people that are looking to try to lock in. I mean, the days of calling, once again, we talked about this, obviously in past podcasts, we have webinars that, to shop around, to call one lender in the morning on Monday morning, then call another lender Tuesday afternoon. That's just not fair.
Yeah, it's going to be different.
It's just pick a lender. This price shopping, like I said, to try to save $1,000 or $500. Like I said, I'm very competitive on my pricing, being a broker, so I can shop. That's the beauty of me on this side, being a broker. I've got 55 lenders that I can look at on any given day. So you call XYZ Bank, they're going to give you their rates. But if you call me or a broker, they've got access to 50 to 55 different lenders and see the best pricing and see where we're at. And so it's definitely to my advantage. I'm not locked in any, given set of rates. But it's, make a long story short, it's been very volatile. We're seeing some basing. Go back to the chart real quick. We're seeing some basing out here now. I mean, it's been basically a staircase, downward. But we're seeing a little basing out here the last, week and a half, 2 weeks, which is a good, good sign, because maybe obviously, the market's taking effect that, we're going to see some type of rate hike. And tell me, they might, who knows? They might surprise and do 75 bips. You never know. But and then make a long story of it on the talk about Barry rates and Barry Habib. I'm just going to jump into this. He thinks can I show the other chart?
Yeah. You're on.
Okay. This is kind of interesting. I mean, he's, you got our infamous leader talking about, we don't know if we're going to see a recession. They're talking, you saw him talking yesterday. Well, they're talking about maybe a recession. Barry Habib is the one who said that, back last year that the inflationary was not transitory. So this guy's been spot on. Barry Habib has. And he says we are going to see a recession. And his thing is rates in a recession, rates do go down. He said we're going to probably see peak inflation by September, October. He said you're going to see the supply chain loosen up a little bit. Basically, inflation is going to probably decrease September, October. The federal funds, obviously the increase is going to take hold. It's going to be kind of a demand destruction. It's going to destruct demand a little bit. And then you're going to see lower rates. And, there's going to be a window in time, maybe 6 to 8 months out. But he pointed to, this is the chart that he pointed to. This is the federal fund rate, how they increase it. If you look at it, it's pretty spot. I mean, he's right. I mean, you see the federal funds go up here, recession. They go up here, recession. The gray spots are recessions. So Federal funds went up, recession. Federal funds went up, recession. Federal funds. So you see all these gray areas. After the federal funds went up, there was a recession, almost by clockwork. So, and then you see down here, he's got this unemployment rate and recessions. Anytime the unemployment rate hits a low point, which you see down here, recession. Down here, recession. The dark spots are recession. So unemployment hits low here, recession. Unemployment here, low, recession. So unemployment hits here, recession, this dark area hits low. So here we are now with this and this combined. Chances are we are going to see a recession, and he's saying that we're going to see, by September, October, November. And I think adding in the mix that, not to get political, but I think if we have a regime change, if they loosen up some of the stuff on the energy side, it's going to, they're going to still increase rates, but I think if they decrease regulations and, stop some of the stuff that's been going on here with this administration, I think you're going to see rates kind of, pull. It's going to be a little bit better.
Yeah, it's going to be interesting to watch because we know that the central bank has to clamp down hard to slow down inflation, and that the only way they can do that is to get us into a recessionary mode. And Terry says, I've been following Maricopa notices of foreclosures, about 13 a day or 15 a day. But I think, and then we'll talk about how a recession affects real estate prices. Yeah, Terry, I mean, I think you're seeing some of those numbers, but compare it to what our normal foreclosure rate is anyway. It's usually around 2-3%, which just in any normal economy. So because they've been held back because of forbearance, I just don't see, I think we're probably going to get back to what we see as normal rate of foreclosures, and it's going to seem like an alarming jump, and it's really just getting back to normal. There's always a percentage of people that for one reason or another are not able to keep up with their payments, but I don't see it being a spike. As far as, and Terry says the most are from Mesa. So how a recession affects real estate is all over the board, but as a rule, it hasn't been a severe beatdown. Remember, 2008, the real estate collapse caused the recession. But if you go back and look at other recessions, there are adjustments, maybe down 3%, 5%, because face it, a recession is several quarters of negative growth, and that affects purchasing power. And so, you'll see something, but I think what it does, to Pat's point, is after we've been in a recession for a while, then, inflation starts to get tamped back, and then there'll be some relief on rates. And so that's what remains to be seen. And one of the things that we're seeing now, which is really apparent, and we got another comment here that says, Phoenix area is great to visit winter. No one wants to be here in the summer. I'm going to be in this travel trailer. This is the Cromford Demand Index. Now, 100 is normal demand. And this is Scottsdale. And you can see on here, and let me get my mouse over to that it's hovering at 94. So demand is below normal in Scottsdale. In Mesa, where Terry was pointing out the foreclosures, theirs are right there with Scottsdale at 94. But the standout is actually Maricopa. Maricopa is in the drive to qualify neighborhood, and they're 147. So it's still very good buyer demand out in Maricopa. But every one of the others are now below 100. If you take a look at this and even look at Chandler, they're clear down at 77. Buyer demand has dropped, and mostly because between $500,000 and $1 million, which, believe it or not, is considered the middle zone now, people are backing off. That's what we're seeing. And I'm not afraid to say that I'm in Maricopa, Wickenburg. I'm not afraid to say that if you're thinking of selling, and you were thinking of selling, and you wanted to be at the peak of the market in a really aggressive time, that I think that opportunity is fading. Do I think you're going to have a hard time selling your house over the summer? No. Do I think you'll see less and less offers and bidding wars? It's clear that you will. You won't see as many. Now you will today. Boots on the ground are going to tell you that there's a lot of offers going on. I'm sure Jackie can attest to that as well, that there's still multiple bid situations. But I think it's fading, don't you, Pat?
Yeah, no, definitely. I mean, I'm seeing it. I just got a news release that Flagstars, I don't know how many people they're letting go. I'm seeing, news every day that lenders are, letting, so many, employees go and stuff like that. There's going to be an attrition on our end. I see a lot of, like you said last week, I see a lot of gurgling going on my end. Loan officers complaining.
No.
No, which, no, there are no 50-year mortgages out there. But
yeah, I know in the lending industry, mainly because of refinancing, that they're laying off a lot of people. But I think we're not seeing the remember the pillars that we're tracking are we seeing more contingencies being accepted?
Yeah.
Not yet. Are we seeing higher contributions to closing costs? Not yet, but I think we will.
Yeah.
Our inventory is still painfully low at 6,500. Remember, in 2007, our inventory was 65,000 homes.
Yeah. That's a big difference. That's a big difference. It's huge.
Yeah. So I think, we're a long way off from seeing actual sales prices going down, but I don't think we're far off from seeing buyer traffic
it's
really
cool.
grinding. And so if you're used to, look, these companies that are putting coming soons on and only letting you watch the place for 2.5 hours are probably only going to have 1 or 2 people visit instead of the 30 or 40 that they've had. Just guessing. Put your house on the market, make sure it looks nice, and it may not sell in 6 hours. We're spoiled. But I don't think you're going to have a massive price reduction. Now, our price reductions are up to about 1,200 every 7 days now. That's up about 400 more than normal. That's another sign that sellers. That's a sign that sellers said, "Oh, I thought I could get this. Oops, I can't."
Yeah. I'm seeing appraisals come in lower. There's always this lag effect, and we were talked about. Remember, before we got on, we were just chatting about, the rates going from 3.25 to 5.5, 5.75 in some cases. Those numbers, just FYI, those numbers aren't going to show up for another month and a half, 2 months.
True.
And that's when you're going to get the news releases. If we see a little softening, then you're going to see they're like, oh my God, the world's falling apart. That we're going to see the news articles of the sensationalist news articles that say, oh my God, real estate's down 40%, and the contracts.
Yeah, they're going to talk about how many contracts are written, how it's down. Now we're already starting to see some articles, and I want to share this one with you as well here. Investor who called housing top and bottom says it's time to sell. Now, I always like to read the entire article and see what's really behind that. This one cracks me up. Now, this guy called it. He's a bond manager, sold his California home in 2006 when he predicted the housing bubble would pop. He bought again in 2012 after U.S. prices fell more than 30%, found the floor, right? So he made the good move.
He got foreclosed on in 2006. And
So now, after a record surge in prices, he says it's time to sell is once again at hand. But hold that thought for a moment. When you get down to the end of this, and he's talking about his charts and everything he looks at and he's justifying everything he says. But then he ends with this, Pat, and he says down here, where is it? Buying a home in today's market would likely yield about a 2% return. He considers his home an investment, refusing to form an emotional attachment to his property. It's only a good investment if you buy the right time. If I were to buy a house today, I would probably get 2% max return on it. Well, what's wrong with that?
Yeah.
That's not a crash.
No.
And
he's kind of, his viewpoint is, kind of like a stock. I'm gonna buy a stock at 10, and if it goes up 20, I'm gonna sell it. People buy a house. Obviously, they need, they're tired of paying, somebody else's rent of 20. The rents have gone up from $8. They're in the $1,800 to $2,300 range. For $2,300, you can get a pretty damn good, house.
Well, and I see this a lot. 77 years is, I wish it would fall to pick up a foreclosure. Let's talk about foreclosures for a minute, because everybody's waiting in the wings for foreclosures. What causes foreclosures for the most part? Is it the fact that prices have gone down and you bought your home and now it's worth less because you don't have to move, right?
Yeah.
So it's the loan product that causes foreclosures, or it's your job loss.
Or, somebody has a major illness. I mean, major sickness that they just, they get caught in their,
So for
whatever.
the majority of homes that are on the market right now, they have so much equity that
$6 trillion.
It's going to have to be a hell of a change to get foreclosures showing up. And we're seeing them a little bit, not that big a deal. And you know what? Guess what? Sometimes they're not really that much of a bargain. The banks lately on foreclosures, first of all, they sell them to you as is. You get it inspected, and they're not going to fix anything. It's as is. Banks lose on average $65,000 for every foreclosure that they get. So you end up buying them as is. They don't end up being quite the bargain that they used to be. Now, if they get a whole bunch of them, then you can pick them up like crazy. But the problem with that now, let's say you're the average Joe and you want to go out and buy foreclosures. Do you think the investors don't want them?
Yeah.
They're going to be out in droves.
Low hanging fruit's gone on that area.
Yeah. And now these investors and these Wall Street firms are way more organized and funded now than they ever were in 2008 when things, crashed. But, I don't see any comparison between now and 2008, just simply because of the loan products and because of the fact that, look, folks, until we have that high inventory, forget about price reduction. Just forget it.
Yeah.
If you're trying to sell and you need to sell fast, that party's changing. But that doesn't mean that the prices are going down yet. There's a lot of stuff that has to happen. And Adam says, as is sweat equity. Could be.
Yeah.
Maybe. Depends. It depends who you're competing with to pick up that foreclosure. So, I'm not against it. I'm just saying, based on the numbers I'm looking at now, I don't see a wave of foreclosures coming.
Yeah. No, I don't either. And like I said, that if I was not there in 07, 08, I saw before everything hit, and while I saw before the storm, during the storm, and after the storm, and I'm convinced that it's a totally different thing. Just a side note, I'm hearing a lot of people like, well, I'm going to wait for rates to drop before I buy. We had talked about this. If you're, once again, we've been kind of probably repeat myself from the last couple of podcasts, but if you're looking in a position to be able to own a home and get something, if you can use this crack in the ice the next couple of months, maybe we see something, you might be able to see an opportunity. I think it's kind of like a stock that goes from 10 to 40, but when it goes from 10 to 40, it goes from 10 to 20, but then it backs off to 16. That might be a good entry point before it goes to 30. I mean, I think this little period in time, the next couple of months, might afford people an opportunity to loosen up where there's not as much competition. Because the problem is, if people use rates to say, I'm going to wait for rates to go down, well, the problem is you buy a house now, you say you get locked in at 5.5, and rates go up, you look like a hero. But if rates go down, you're gonna have more competition. More people are gonna be able to afford a home, to buy that home. So don't let rates control your buying, influence your buying.
Yeah, there's a lot of people waiting in the wings right now to try and get into a home when they smell an opportunity. And Running It Out says there's too much equity for people to foreclose. If they need to be, they could sell the home in a few weeks. They really could. And for those of you out there, if you're even just pondering a little bit about selling your home and wondering what it's worth, Pat and I can give you a report that is probably more detailed than you've seen in a long time. You get on Zillow, you're going to see his estimate. You get on Redfin, you're going to see his estimate. We can send you a 3-page report that shows you what's going on in your neighborhood with all the detail that you need, and we can get it to you pretty quick. So just email either one of us and say, hey, I'm curious. What's now, again, I'm not in your kitchen, so it's going to be a rough estimate. So don't take it, oh, it's $450. I thought I was $475. You might be. So it's, be careful with online estimates, but this is a very detailed report that shows what homes have sold in your neighborhood. It's really a winner. What do you think about the property tax increases combined with everything being expensive that will soon come? Are people ready? Well, Arizona is, they've got a much better way of calculating the taxes versus some states. Like Washington State, you're going to absolutely get your butt kicked. New York, you're going to get slaughtered. Arizona, they're going to go up. I don't know how much of an impact it's going to have on people. Depends on when they bought. And I think we have a 5% cap, I believe, if you're in your home. So, we'll see what happens. I don't think it's going to throw anybody out of their home. GMP, once the recession starts, we enter depression levels by 2023 second quarter. When should it be a good time to jump in the housing market again? I don't know. I can only tell you what's going on the next quarter. I have no. I wish I was that good. There's never any numbers to look at to tell you what's going to happen in 2 years. There's only speculation.
Well, Warren Buffett said that if you had a company that had an economist on the payroll, he said he had one employee too many.
That's probably true.
Warren Buffett even doesn't use.
Running an altitude says, do you expect the luxury market to fall first? The luxury market's tied to stocks, tied to corporate earnings. So if you start seeing in the luxury market that those numbers are really, earnings aren't there, stocks are falling, then yes, that'll get hurt. You'll see that.
In terms of foreclosures, though, we talked about this before. I mean, it seems like 8 out of 10, 9 out of 10 people are buying anything in $1 million, $1.5 million, $2, $3, $4 million range. They're paying cash. So that doesn't. Yeah. I mean, they're the ones who are assuming the risk. If you like, it goes back to that like we talked about last week as far as these people that buy $1.5 million homes and pay cash. If you're looking for the market to fall, you should be paying cash for the thing. You should be leveraging a little bit so you're not putting all your money in the thing. But if you're paying cash for a house, you bought a house for $1.5 million. We go into a kind of a dip. Okay, so your house is worth 1.1, 1.2 million. If you need to sell, that risk is on you, not the lender. The lender doesn't take the risk. You're the ones who are taking the risk as the buyer because you got it all.
And there's, here's the deal with housing. It's not a stock, and there's a lot of different directions this market can take. Yeah. Just because we had a crash in 2008 doesn't mean it's a natural occurrence. Yep. We might have another one. I don't know, but I'm just looking and going, there's a lot of other things that could happen as well. It could just stagnate and stay put. You could buy a house for $550 and it might just stay at $550 for 4 or 5 years. Yeah. Okay. And so it may come down 5%, and it may stay there and waddle along for a while. They do 1031 exchanges too for luxury market. Absolutely. They try to stair step up, but there's a lot of different directions housing. Just because it's gone up fast doesn't mean it's going to crash.
No.
But it is time right now to pay close attention if you're overextended. If you got a couple rental homes, and your renter's gone for a month or the rent dips and you think you're going to be pinched, pay attention. It's time to pull out your pencil and take a close look.
Well, remember that, just go back to my chart, go back into my screen. I mean, obviously we talk about the supply demand. This chart shows you how many, this has been, remember I've been kind of blurting this out the last couple months too. This is a phenomena that we have never dealt, this is another phenomena that we've never dealt with in the last 30, 40 years because we never saw rates where they were at. Right, this number right here and above all these mortgages in here, that's 38 million homes that are basically, I think, 4.5% or lower. You got 13 million homes that are between interest rates of 2.5 to 3. You're not seeing those people move. If rates are at 5.5 or 6, I guarantee you they are not moving. Yeah. I mean, the only reason they're moving is because they got to move. So that is part of the reason I think we're seeing this little. That's my philosophy, and I've stressed that a couple of times, but I think that's one reason why you're not seeing the velocity of homes. You got people at 2.5. Look at this. You got 4.7 million people between 2 and 2.5%. Rates at 5.5. I don't care if you got $300,000, $400,000, $500,000 equity. If they want to buy $800,000 home, they're still taking out $200,000 or $300,000, $400,000 loan at 5.5%. If you were at 2.5%, you'd be damned if you're going to take out a loan at 5.5.
Yeah.
So that's part of my argument too, is why we're seeing supply demand kind of buck up, because you got 38 million homes from, like I said, 4.5 million or 4.5% and down, 38 million homes that are just kind of tied to the interest rate too.
Yeah, and I think so. You've got 3 pillars I think that are squishing inventory. One is just what you showed, the biggest reason. Second is Airbnbs. Scottsdale alone has 5,800 of them. And the third is investors buying them and using them for rentals. So that one, we're starting to see some pressure points in places like Mesa. And so that, they may not get as much rent as they hope, but it hasn't gone down enough for them to say, I'm out. But, that'll start to crack one of these days.
Yeah.
So, but, buyer traffic is definitely on the skids. And, but remember that our lowest buyer traffic we ever had was 2,700 homes over a 7-day period. And right now we're still sitting at 3,700. So, Dedham says short-term rentals are the way to go. They can be, and they can stop just as quickly, but they won't this year. You got Super Bowl coming up in 2023, but that's great for 2 weeks. But beyond that, you kind of have to be careful. You got to watch what your neighborhood associations are doing and your local cities and municipalities, because they are changing some of the rules. They're trying to clamp down on some of the activity. Just letting you all know, finally under contract after a fun 6 months. Way to go, Yams.
Congrats.
Got the best logo there ever. If you're in surprise, the training season brings in renters, charge more during peak season. Yeah, people do that. So I think until there's a reason for people to sell their home and they feel like they can do it without taking on a large mortgage, inventory is going to stay in the toilet. Yeah. So I think I have no prediction for that. The only thing I can predict safely now, I'm going to say it, in the next 6 months, if you're thinking of selling, that you are going to see buyer traffic decreasing. You're going to see some declines in bidding activity.
Hey, Rick. You kept the audience on suspense. You said I'm going to predict. I'm going to safely predict, and then you came off.
Well, and I didn't do that on purpose, but I must have had a little hiccup there. That's funny. So no, I'm going to safely predict that in the next 6 months, the buying activity is going to be lower to the point to where you're going to see the bidding wars greatly reduced. So if you want to sell your home and you want to see the bidding wars and you want to push it up, get cracking. Now's the time. We're not ringing the bell and saying it's the top of the market for pricing, but I am ringing the bell saying if you want the most boots on the ground going through your home right now and giving you the price, I think we're at the peak.
Yeah. Or short-term peak.
Short-term, yeah. I've been wrong before, but this just smells like we're there. So I think that's where we're at. But happy to chat about it later. But so I want to thank everybody for jumping in, and we'll be back again next Friday. I will be live again Monday morning at 8:30, and I'll sprinkle in a few more videos as the news comes on. You're going to start seeing more and more of that, but I'm going to go look at caverns under the ground. My understanding is I have to wear a jacket because it's pretty cool down there, and sounds like a lot of fun. I'm looking forward to it. So, oops, I got another comment that snuck in here. It says, also nice whirlwind shirt. How's the golf game?
Not too bad. I played down to about 5 or 6. I'm probably playing right now to about 8 or 9 handicap. I get audible once every month and a half, every month or so. That's about it. Thank you all.
Well, I'll tell you what, though, when you talk about my golf game, I've hit some of the finest houses in the country. So, top that. So.
Yeah.
All right, everybody, have a great weekend. Talk to you soon, Pat.
All right. Take care. Have a good weekend.
See
Ciao.
You.